Stewart McDonald, is very well known in Australian resource industry in the past 30 years. He's behind some of the Australian most award-winning conferences, resource and investment conferences, also working in several ASX-listed companies as well as major shareholders. He's also a founding director for RAU Vertical Events and the Future-Facing Commodity Conference in Singapore. So I throw in way for some questions for Stewart is, in today's environment, is it more successful having a best? I'm just asking this question wearing an investor's hat. In today's environment, is more successful about is the success more about best resource or is the best strategy developing the project? Are we moving more towards a fewer, which means high quality, better funded project, or just look at everything that's available and make your own judgment from there? And also, what will be the what will separate the company from make it to production from the ones who don't? So it's a very, very tricky question. I hope, Stewart, you can help me on that.
Rightio. Good morning, everybody. Nearly afternoon. And thank you for tuning in. Thanks, Gloria, for all those nice words and asking the questions. When you invest in a resource company on the Australian Stock Exchange, what you're after is share price appreciation. It's all about the share price. So you want to buy at 10 cents or 15 cents and sell it at a much higher price, etc., etc. The reason the share price will go higher is as the project is de-risked. So if you're starting with an exploration focus only, your share price is going to be quite small and on the small end until you spend some of your money on drilling, get drill results, and you prove up your resource, whatever that resource is. And as you find strategies for developing that resource, your share price can go higher and higher depending on the results that come out of the ground. At the end of the day, it's all about the drill rig. It's all about what's underneath. I mean, you can't develop something that's not there. Only about 10 to 20% of companies, when they drill, find a resource that has potential to be developed in the future. So we work on those 20%. Now, earlier today, we heard David Self from TG Metals talking about his lithium project and his gold project. A few years ago, lithium was a buzz, and people were looking for strong lithium deposits. And Gloria mentioned a Stewart takeover by SQM. Well, TG found and developed not the quite size scale of the Stewart, but a nice deposit of lithium. So they focused on that. However, then we saw the lithium market fall apart. So TG Metals were able to focus their attention away from lithium into gold. They managed to do a gold project, and then they're now working on that and having some success with 270,000 ounces and growing. So the key to that now is to keep growing those ounces and finding a way to get the gold out of the ground. So a milling arrangement, both external and on site. What that will do is supply the company with cash. Some of that cash can then be used on developing further the lithium asset. So as a company, as a board, the board has to be aware of what's happening in the global market, what's happening on the local market, and use their cash wisely and accordingly for the best, what they believe is the best outcome for their matters. Capital has to be spent wisely. So as I mentioned, you need to prioritise your cash. There's no point spending cash on a lithium asset while there's no market for it. But the lithium asset, the lithium price has increased dramatically in the last 3 or 4 months. So that's back in play again. It's not just about having a great asset, it's about whether that can be built and ultimately financed. So when companies go to produce their product, they need a feasibility study, and ultimately they need funding. Now that funding comes from the capital markets or from the banks, it's debt. But of course, we all know that banks are very tight and very risk adverse. So you have to have a very, very strong project analysis to get bank debt finance. Otherwise, you will have to go to equity and use the markets. Execution is the real key to this, execution as a board. Success comes down to access to capital. We just mentioned that. It comes down to strong partnerships, and those partnerships can be with your milling contractor, with your drilling contractor, with your stockbrokers and financiers. And you have to have the in-house ability to plan and develop your asset. I mean, obvious things to say, but a lot of people don't actually get that right. And the final thing is cost control. You must keep your costs under control. You must analyse your costs constantly, almost daily, to make sure that nothing. But of course, what's happened in the last couple of months is that the diesel prices has added to cost. So some companies are not drilling at the moment because the drillers can't get diesel. So there's a holding cost of your asset, or the company just sits tight and holds onto it until we can get diesel. Some of the bigger companies in production are developing other ways to power their asset. Just recently, I was on site at a major mine held by Northern Star, and they've developed and opened their own solar farm. And this solar farm powers most of the infrastructure of the mine, powers all the facets of the administration block, your dams, your tailings, and a long way towards powering the mill. Obviously, these places have to have diesel backup because sometimes the sun just don't shine. So you have to be able to swing in a backup for when you can. So, but it's good to see that some of these bigger companies who have the cash to do it are taking some of the risk out of it by developing their own solar farms. And this model that they're using will then filter down to the smaller companies in time as these technologies become more efficient and cheaper. I think when a company looks at its portfolio, it needs to look at how many they have. Like some companies might have 6 or 7 projects. Now they can't fund, or they can't give attention to 6 or 7 projects. They can only give attention to 1 or 2. So at some point in time, these other projects may need to be offloaded. They need to be sold or joint ventured out to somebody else. And this is where some of the overseas companies can get access to Australian assets, is by talking to the local companies and doing a joint venture or an earn-in agreement on exploration to try and get a foothold onto some of the projects that they currently have not got access to. And if that gives the local companies access to overseas cash or overseas money, in this case Asia, and it gives the Asian investors a foothold into the Australian industry. So it's a win-win situation for both. And that's one of the key things that I think Gloria is working on with her conference later in the year in Singapore. Okay, I think I've just about covered off on mining now. So
Thank you.
Go back to Gloria.
Thank you, Stewart. And shall I able to summarize in success in the current environment? And we look at access to capital, stronger partnership, disciplined phased development, cost control. And the best resource is the one that get developed So the execution is the key. Is that summarize your thoughts? And I know we are time to conclude today's webinar. I just have one more question because it's very important to mention about oil and gas, because over the years I've been attending many of the RIU vertical events conference. One of the events called the Good Oil Conference is a one and rare only stage conference that stage oil and gas projects that's currently developing, doing capital raising, and to support those projects from startup to finish. So my question is, how many of those small mid-cap energy companies are there in Australia? And they were sort of, when we go into energy transition, they were sort of in the sideline a bit, but now they're back to the main center stage. And could gas be repositioned as a transitional fuel, attracting broader investment again?
Interesting question. About 20 years ago, Australia had a prosperous oil and gas industry, with maybe 30 or 40 recognisable companies, some bigger, like Woodside, and some smaller. But what's happened over the journey is that successive Australian governments have wound back what they believe is the importance on oil and gas in Australia, so they can get it from overseas. Well, how's that working out for them now in the fuel crisis? It's not working out very well. Australia has plenty of oil and gas reserves and should be developing its own, but with the green movement the way it is and politics getting in the way, a lot of focus has been taken away from oil in particular. I'm excluding LNG in this because LNG is a monster and Australia is one of the leaders in the world in LNG and will continue to be forever. But in terms of oil and smaller gas, Australia needs to look at its own position and needs to become self-reliant again, or somewhere towards self-reliant. Now, when you look at oil companies now, there's very, very few listed oil companies on the ASX at the smaller end, maybe a dozen, and that needs to increase. So our obsessive reliance on overseas oil has come home to roost in the last few weeks, and it's something that governments now need to readdress. Whether they will or not, whether they stay green, I don't know, but it's certainly on the political agenda of how we solve this in this current crisis. To achieve more oil, if you start drilling today, it's going to be 15 years before you've got to have success, and then you've got to develop it. And then the other thing about oil is you need refineries.
Yeah.
So there's no point having oil without a refinery, because it doesn't serve any purpose. And of course, Australia has also been guilty of closing down its refineries. We've gone from 7 to 2 over the past 10 years. And again, that needs to be readdressed. So for a company that is so rich in natural assets in this area, I think it's fair to say that we've done a very, very poor job of managing it over the journey.
Yeah, that's sad to hear. So in summary, those smaller mid-cap companies are part of a solution, but they can't respond quickly enough to solve the short-term supply because they are still needing funding to push them through to the finishing line, secure capital, move project forward so they can support the energy transition. And also, on the other hand, investor appetite is quite selective as well, isn't it?
Mm-hmm.
Yeah.
With gas, coal seam, Australia has coal seam. But again, the politics of coal seam gets in the way, and governments seem more interested in securing their own vote for the next election rather than solving the issues of the country.
Yeah. Yeah. Well, it looks like we're opening a can of worms. So hoping anyone in the audience have more questions and suggestions, just email us either info@resourceconnectasia.com or to me, Gloria@resourceconnectasia.com. In conclusion, that will bring us to today's company industry presentation. We have covered quite a wide range of insight and country prospects and industry prospects as well. So thank you all for joining us and hope you find the discussion useful. Apologies for a few minutes delay. My name is Gloria. I look forward to connect with you in our next webinar, which is in a month's time. Thank you.